So also on X, we see another post about the idea of portable mortgages, right? Now, if you're in the mortgage business like I am, and you saw portable mortgages, you're like, oh my God, that would immediately like you wouldn't need loan officers anymore. You could just take your mortgage and take it with you to your next property. So let's talk about that option for a minute, because I also think that this is highly unlikely. I'm going to talk to you about the reasons why I think that. And then I'm going to give you a couple positives that I think have come out of this whole conversation. And that's what I think we need to hold on to for now. But let's talk about these portability issues. Now, this is not a new thing, right? There are portable mortgages that exist. Matter of fact, in the United States, we see these sometimes on commercial type debt. And you see this as well in Canada has some portable mortgages. The United Kingdom, some other countries have this. Now, one of the big differences is they're typically not 30-year amortization, right? Like you can't get a 30-year fixed mortgage in most places in the world. Like up in Canada, as an example, I think the longest term that you can get is a 5-year adjustable rate. And same thing with commercial loans. So we're talking kind of more in this structure that would typically be reserved for a commercial type of a loan. And the big challenge with that is it takes the risk away from the investor and it puts it back on the note holder, right? It puts it back on the person purchasing the property to now be subjected to, the gyrations that may happen with interest rates over time. So one of the benefits of a 30-year fixed rate mortgage is that once you lock that in, you've now pushed that risk to the investor side. And obviously that's priced in based on the timing of what the market's doing at the time that you lock in that rate. But it is a fundamental difference in the shifting of risk back to the customer, to the consumer, to that note holder if you go to this loan that may be portable, but it's adjustable on a regular basis with the moves in the market. So this is not a totally revolutionary thing, but here's why I really don't think, besides the, is it a good idea thing, there's some other reasons why this probably wouldn't work in the United States. And first of all, the market that we have for mortgage-backed securities is very stable, but it's also very dependent on individual loans being secured by individual houses, right? So an investor knows that the collateral in which they're investing in is a home. There's a physical property there that has a specific lien against it, whereby if that borrower does not pay their monthly payment and the investor loses out on that, there is repercussion for that. And so all of the paperwork, all of the disclosures, everything that is done in the mortgage business is about underwriting a package that is not just based on the borrower's creditworthiness, but it's also based on the collateral in which you are leaning. And then all of the paperwork, ties that all together. So when you bring in the idea of keeping that note and then making it portable to multiple different properties over time, there's just no infrastructure to be able to support that in our MBS market as it exists today. So, and none of the documents that are, built into, this pooling, the servicing, the list goes on of all the different language that would have needed to be put into not just the original note and the deed of trust and all the security instruments when you close the loan, but also all the agreements between the banks and the investors that are buying, these more and investing in these mortgage-backed securities. So I don't see how you could possibly change all of the existing loans that are out there and all of a sudden make them portable, right? So perhaps we could talk about new loans that have a portability feature, but we'll talk about that in a second. Okay, so I got some notes here. Not only that, you guys, mortgages, when you think about the servicing value of a mortgage, right? So you got the value of the note itself, like what's Fannie Mae willing to pay for this 30-year fixed rate note, and then you got the servicing value. Well, think about the servicing value is based on an assumption of prepayment, right? Either through refinancing or through turnover, right? That person buying a new home. This would completely blow up every prepayment model that exists out there, because there would be, well, assuming it was a really good interest rate, there would be no need for prepayment. Meaning no need to refinance that loan, or you wouldn't be selling it when you purchase the new home. You just move it with you. So this uncertainty about servicing would more than likely widen, premiums on MBS and probably drive up the interest rates a little bit, would be my guess. And then think about this for a second. So mortgage companies wouldn't, you would still need to originate new loans, but most of the transactions we're doing, like we know right now that I talked about this in the last podcast, 20% of purchases are first-time home buyers. That assumes that all the rest of the mortgages are not first-time home buyers, meaning they probably own a home right now, a good portion of them. So you would decimate the mortgage origination, companies, because you really wouldn't need that. But then who's going to do all this paperwork? Because there's still a ton of work to be done on these, and it would have to be the servicers, right? So the servicers would now have to become the people that are, you still have to do a new appraisal. You got to get mortgage insurance for the new loan. You got to get new homeowners insurance, maybe flood insurance policies. Like, is it a condo? Is it a PUD? Like, I mean, you guys, there would still be an origination process to slide in this new piece of collateral. And who's going to do all that work? Do all of a sudden the servicers become like the pseudo originators of these portable mortgages? Or I don't know, a lot of unanswered questions on how that would even work. And like I said, I got my notes here, new mortgage insurance, you got to treat this like a loan modification now. Is it just a loan mod where you're swapping out the property versus a whole new loan? What about TRID? Like, what about how does that fit in, to the equation? And then, just the pooling of loans and the tracking of those loans, and then finding where that loan's at, once it's sold into the secondary market, to be able to kind of pull that out, replace the property, put it back in service. I just don't see how all of that would play out.